bedding giant Tempur Sealy had another bang-up quarter as all those new pandemic home buyers bought mattresses for their new digs. But the company wasn't immune to supply chain challenges, telling investors it left $100 million in business on the table because of those challenges. Scott Thompson is the chairman and CEO of Tempur Sealy and joins us now. Scott, good to see you again here. So what is it like as the CEO of a publicly traded company to essentially just turn that amount of business away because of an issue you didn't create?
Well, look, it's always a challenge to run any company. We all have challenges we have to work through. A couple of things. Look, we didn't turn away all the business. About $100 million ended up in backlog, and we'll get that delivered in the fourth quarter. And in fact, we expect the fourth quarter to be a record fourth quarter because of the strength of the business and as we work off that backlog. We also turned down another $100 million that we didn't even take the orders where we have customers on allocation. If we had gotten both our backlog built and the customers returned down, our sales, rather than it being up 20% in the third quarter, would have been up 40%. So it's a little disappointing, but look, it's a good time to be in the bedding business worldwide, and we feel very fortunate.
Where are you seeing these supply chain challenges, Scott?
You see it a little bit everywhere. We have 67 plants worldwide. We actually sell beds in 100 different countries, around the world. So we're everywhere. Where the biggest problem is in the United States, and we're seeing it a little bit in trucking, obviously the shipping, a little bit in the component issues, primarily chemicals. But it's getting better, but it continues to be a challenge, and we think we'll be working through supply issues probably here for the next couple of quarters.
Scott, can you talk a little bit about what Tempur Sealy has been doing and plans to do in order to continue to navigate some of these challenges? Because I know during your earnings call, your company was talking about opening 3 new manufacturing facilities and just recently having broken ground on a new domestic facility in Indiana. So what are some of these strategies?
Yeah, look, we're very fortunate. The Tempur-Pedic product's doing very well in North America, as Stearns & Foster and Sealy brands are doing. Sealy's #1 brand in the United States, Tempur-Pedic's #2 in the United States. So our biggest challenge is to ramp up to that demand. What we're doing, look, we're hiring quite a few new people. We're putting a new plant in Crawfordsville, in Indiana. We have diversified our supplier base to kind of de-risk some supplier issues. Look, and the men and women are working very hard, really across the organization. But I think the point I would make is that it's not really just for the current capacity; it's for what we see in the future, as we're expecting double-digit growth next year.
How much have you had to raise prices, given the inflation you're seeing?
Yeah, we've actually raised prices 3 times in the last 12 months. And we'll probably have to do another round here pretty soon.
Scott, you teased on the earnings call you are about to come out with a gel pad product. Is that something directly aimed at Purple?
Well, not directly aimed. We've had what I call the crushable grid, which is a component to a bed that gives a bed a little different feel. It's kind of a niche product, and so we're going to come out with it next year and see how it does. I don't think it'll be large compared to our other product lines, but we basically believe that we should service all of our customers. We have entry-level beds all the way up to premium beds, some innerspring, some primarily Tempur material. So wherever we see these markets, some of them small, we go after them.
And speaking of markets, where are you seeing some of the biggest growth opportunities, either domestically or internationally?
Yeah, domestically, you probably, take it back. Let me do segments. The biggest growth we see is really direct to consumer, and our direct and consumer business grew 79% last quarter. So that's been a big growth area. We recently did an acquisition in the UK, Dreams, and we're now the largest bedding retailer in the UK. Good growth from that acquisition, and that acquisition is performing very well. Another product that we have in the United States that's doing very well is our Smart Base, which is a technology that will monitor your sleep, send your sleep stats to the cloud, and then send you an email coaching you on how to get better sleep. So our smart base has also been a big product for us here in the U.S.
Well, I get no sleep, Scott. So clearly might be something I might be in the market to. We got over the weekend some favorable news on the steel tariff front between the EU and the U.S. How does that impact your business?
Well, we're hoping the steel prices go down. That would be a component, obviously, in building springs, which go into beds. And it'd be very good for us in the market from the standpoint of get a little bit of the inflation out of some of our components.
I'm wondering too, when you think about marketing in light of some of these supply chain challenges, how are you thinking about directing some of that spending when, again, you are sort of still working through some of these constraints while still trying to make sure that you're getting word out about some of these new product innovations?
Yeah, well, very, very insightful question. It's something that we debated, obviously, for the last year. What we decided to do was not pull back on marketing. You could make the argument that in a constrained environment, maybe you ought to try to optimize your financial statements or pull back. Look, we believe in brand and we believe in investing in brand. And so we have kept our foot on the pedal and continue to advertise at the same rate that we have historically. And we'll continue to do that because we think of it as a long-term investment. So we've not cut back in advertising in any way during this period.
Scott Thompson, Chairman and CEO of Tempur Sealy. Good to see you and good luck this quarter. ZoomInfo is out with better than expected sales and profits as companies invest in data services to help drive new sales and leads. Let's check in with ZoomInfo's co-founder and CEO, Henry Schuck. Henry, good to see you again here. My friend sent me a message this morning. He's like, ask Henry about the wide moat around his business. So for those not familiar with what you do, what are you doing that competitors aren't? Because I think that would go a long way to explaining this quarter.
Yeah, great. Thanks, Brian. It's great to be here. I think the big thing you see around our business is we help go-to-market teams digitize the way that they sell and market their products. How we do that is we start with an intelligence layer, which is an incredibly robust data asset that's based on companies and the decision makers who work at those companies. And we take that intelligence layer and we drive it up through an orchestration layer that lets you take signals off of when companies are growing, when they're shrinking, when they're getting funding, when they're hiring new executives. And you can build a go-to-market motion around that. Most companies know that when some event happens at their potential clients, that they should be interacting with them. We not only give them the signals, but then the digital technology to actually interact with them in real time. And we're seeing more and more companies take that on. And in the quarter, we grew 60% year over year in the quarter. We did that with best-in-class operating margins, 39% adjusted operating margins. And we continue to grow the business in the SMB and the mid-market and the enterprise. So an exciting quarter as companies digitize the way they go to market.
Henry, this is Emily. Of course, with the explosion of demand that we've been seeing for software services over the course of the pandemic, I'm wondering what services specifically have been driving growth at ZoomInfo Technologies, and what do you expect to continue to be these drivers going forward?
Yeah, look, I think the big thing that we're seeing is, in the sales universe, you have a huge millennial workforce. I think the majority of people in sales and our customers are millennials. I'm a millennial just by a little bit, but millennials expect digital technologies in their work life. In their personal life, you think about an analogy here. When I sign up for Instagram connects my contacts. It connects the people I know. It starts sending me content that I'm interested in. It tells me people I should follow. In the B2B world, when I come into the workforce, the technology is not designed like that. It's not telling me what I should be doing. It's not making me successful. It's not using algorithms to increase the likelihood of my success when I'm selling my products or services. And what we're doing at ZoomInfo is we're bringing that same level of customization and automation to the go-to-market workforce because they deserve it. In today's world, business software should be smart. It should drive success. It should be able to help people actually be successful in their jobs. And our technology helps salespeople, marketing people, and recruiters become successful in their jobs just by leveraging technology and data and serving it up to them at the right time.
The lifeblood of your business, Henry, I would argue, is not necessarily the data, it's the representatives or your team inside your company. You ended the quarter, I think, with 2,500 employees. How are you recruiting them in this tight labor market? What are you doing?
Yeah, so easy plug here. We use ZoomInfo Recruiter, which is a platform that we've built for the recruiting market to hire new individuals. We believe that that data asset is one of the best passive candidate resources available. And in the quarter, we saw incredible momentum on our ZoomInfo Recruiter product. As the global war for talent becomes harder and harder, it's incredibly important to be able to be out there and recruiting passive candidates to come work for your companies. And so we're driving that. We were recently named by Fortune magazine one of the top workplaces for millennials. We've also won a number of diversity and inclusion awards. And so number one, we built a great culture at ZoomInfo, so people are excited to come work here and excited to stay here. And then we're using our platform to recruit new individuals into the company as well.
Henry, I'm wondering as well, as the company continues to grow, are you seeing a sort of pricing power when it comes to actually driving the prices of some of these services that you're providing on the software side? Or is the goal right now still to continue to grow that customer base just at this point at current pricing levels?
Look, one of the great things we've been able to do, we went public last year, June 2020. Since then, we've made 5 acquisitions of companies that play around the sales technology space. And we've integrated those acquisitions into the core ZoomInfo platform. What we think that gives us the ability to do is provide value-based pricing to our customers, where they're able to get more than just our intelligence layer, but they're able to get a number of technologies that they're able to use day to day in their go-to-market motions. And we're able to drive value by combining multiples of those solutions into our customers and save them money versus buying each of these off the shelf and then going through the process of integrating them all together. Our vision is to build a modern go-to-market platform that brings together a number of these technologies and then is able to drive that value to our customers and help them save money on by having one unified platform.
Henry, from your vantage point, when do you think the Great Resignation ends or cools down a bit?
Look, I don't think it ends. I think this is the future of business. Employees expect a lot from their employers. They expect them to step up on social issues. They expect them to step up to help make them successful and invest in them. They expect them to set up to help them be more successful and grow their careers. And unless we as employers are willing to step up and meet that challenge, I think this is the universe that we live in going forward.
Henry, real quick before I let you go, I heard you have a special viewer watching you live now.
Yes, my daughter Grace, she's 5 years old. She's watching us live now. And my wife Jessica. Thank you for that, Brian.
All right, well, we appreciate Grace tuning in. Yahoo Finance, cultivating next generation of finance viewers. ZoomInfo co-founder and CEO Henry Schuck. I'll catch you in Slack, buddy. Have a good weekend.
Black Rifle Coffee Company just announced today that it's going public via a SPAC merger. The deal is valued at about $1.7 billion and is expected to close in the first quarter of 2022. For more on this, we have Evan Hafer, CEO and founder of Black Rifle Coffee Company, with us now to discuss. And Evan, thank you so much for joining us today. Tell us a little bit more about this deal. Why now for this plan to go public? And what is your company's plans for the cash that will hit your balance sheet as a result of this deal?
Yeah, I think now is important based on the timing. I think we looked at it for the last several years. This has always been a goal directly related to our mission of hiring 10,000 veterans. I think this is a good time for the company to announce this. With the partnership with Silverbox, they were aligned with our mission and our intent, specifically along the lines of our philanthropic endeavors. We wanted to capitalize on the inertia of the brand, want to make sure that we could share the success of the company with the shareholders, and it felt like the right time for the company with the right partnership.
Evan, Brian here, of course. Thank you for your service to this country. As part of this deal, you will get $225 million put on your balance sheet. Where do you plan to spend that money?
Well, we've got 2 big growth initiatives for the company. Obviously, we're a hyper successful omni-channel company right now, but the big initiatives right now are going to be an Outpost, aka coffee shops, and our ready to drink. Our ready to drink is right now sold at about 40,000 convenience stores nationwide. We'll be expanding those initiatives. The coffee shops are a really big component of the placement and the authenticity of the brand, being able to hire more veterans and serve the customers where they live. So those are the big two investment initiatives we'll be making over the next couple of years.
Evan, I also wanted to ask, just in terms of location expansion, where are you seeing the biggest opportunities here? Because, of course, there is considerable competition in the coffee space already and in the beverage space.
Right. Well, I think with Black Rifle Coffee, the difference is that we're an authentic American company. You know, we're a true American success story. I think people are hungry in the United States for a brand that represents them and their success story. I think there's a sea of inauthenticity as far as in corporate America. Black Rifle, from my perspective, I started this company in my garage 7 years ago. Before that, I was working in Afghanistan and Iraq. We founded it with a group of my other veteran friends. I think people are hungry to go out and really experience a coffee company that represents their values and really is mission driven and dedicated towards giving back to the veteran community itself. It's something that we do and we strive for every day, is not only serving a great cup of coffee, but it's also what can we turn the coffee drinkers, what can we turn their dollars into as far as good philanthropic endeavors? I think the big expansion and the big interaction is going to be within the coffee shops themselves, being able to experience the brand in a totally different way. The subscription is always going to be a really big component of the company. It's one of my favorites. I started this so I could deliver fresh roasted coffee direct to the doorstep, but now it's time for the next level of the company.
Evan, what do you say to those critics who point to your marketing on the cans and your support for the police? I mean, do you just say to them that your brand just might not be for them?
Well, first and foremost, I served this country for over 20 years. I served alongside, I think, some of the most heroic and service-driven people this country has ever produced, either overseas or here. A lot of those veterans transition into law enforcement and first responders. There's a group of people that truly love their country and they're passionate about serving their communities. Those are my people. I think there's a lot of people in the United States where that represents their values and their connection. To be honest with you, I'm not really that concerned. I love this country. I'm never ashamed to say that. I love the wide variety of people that have served this country in varying capacities. I love connecting with my customers across the country. This is not just about, how big can the company get? This is about connecting with the customer and then giving back with a real mission to the veteran community. I can't think of a better country to celebrate that story in.
And I'm sure you're going to get these questions now that you will be a public company, Evan, but I mean, should your brand be associated with that far right community, or that's not the case?
Well, the brand is associated with people that love America, and they're not ashamed about that. I think this country has given me so many different opportunities. I grew up in a very rural community in northern Idaho, generations of loggers. And I've been able to travel the world and experience so many different countries and so many different things directly representative serving the American Constitution. It's time for me to give that back. And the customers that believe in that mission and believe in the American success story, they're going to be attracted to this regardless of a political party or affiliation. I think there's a lot of people that truly do love to celebrate America, and that's me.
Well, if you work from home, why not get paid to do so and maybe do a little relocation? Towns and cities across the U.S. are offering amenities and perks and sometimes outright cash to people to move to their fine jurisdictions. And we're going to talk about this. We have the mayor of Greensburg, Indiana, Mayor Joshua Marsh. We also have Evan Hafer. He is the MakeMyMove co-founder. And Mayor, I want to toss this to you first because I'm reading through the list of perks here, and they're pretty compelling. $5,000. This is to offset moving expenses, co-working arrangements, YMCA membership, gift cards to the seasonal farmers market, and my favorite, grandparents on demand. What's your thinking behind this, and what's the uptake so far?
Sure. Well, thank you for having us. Actually, it's been tremendously successful, and we are really working to bring people to our community who want a lower cost of living, a safe community to be a part of, great schools in the Midwest. So we really reached out on this idea that we could provide that, and by doing so, we're helping with relocation costs up to $5,000 in that capacity, and really focused on making sure that once someone moves to a community that they feel integrated and involved and a part of the community. So that's what we're doing with all of these different memberships and seat at the table. And then also to make sure that those parents that maybe want to have a date night on Friday night and their kids have a grandparent during grandparents' day at school, have that quality of life component that's important to anybody, no matter where they live at. So that's what we're trying to do. We want it to be completely successful, and we've had over 1,500 applications to move to Greensburg, Indiana, and we couldn't be more proud of the MakeMyMove team and our partnership to do just that.
Yeah, it's pretty fascinating to see all of these offers listed on the MakeMyMove site here, particularly when we look at it, Evan, around some of them, 20 grand potentially, the highest one I'm seeing here for Lewisburg, West Virginia. Talk to me about where this idea to do Make Your Move came from, and kind of how many people you've seen take you up on the offers.
We're really living through a pretty interesting time. During the pandemic, millions of people suddenly became remote, and that means that they can choose where they live and work independent of where their employer is. So really, this is just open season for communities to recruit new residents, and Greensburg's doing a great job at that. So across the country, there's over 50 of these communities that are offering direct to worker incentives, anywhere from $5,000 to $20,000 to make a move.
Yeah, I mean, it's fascinating to see the $20,000. You think about the cost of adjustments here, getting to do so and paid to do so for better living. I mean, how many people have taken you up? What are the numbers like in terms of, especially in the pandemic?
Yeah, I mean, we're kind of early in the process, but we've seen thousands of people move, and they're moving for a lot of different reasons. They're often moving from bigger cities, Silicon Valley, New York City, and they're looking for places that are more affordable, maybe closer to family, maybe a place that they can connect with the local community. And so, we're not at all surprised that Greensburg and Mayor Marsh are seeing such traction, because that community offers all of those things. It's a great place to live. It's affordable, and obviously their community is committed to plugging people into the community, with offers like the Grandparents on Demand and Seat at the Table. It's really resonating with the audience.
And Mayor, I'm wondering, how has this improved your tax revenues? And I'm wondering if you did any kind of calculations before you proposed this arrangement, where you did a cost benefit analysis and said, all right, here's what we can offer, here's what we're going to take in, and now here's what we're actually taking in.
Sure, and that's actually been a big part of our conversation, and why we ended up here is we've done economic development incentive agreements with companies and corporations for decades. We're home to Honda Manufacturing of Indiana, and we make a lot of cars and car parts with foreign direct investments that have been a part of our community for years. And so now we've sort of shifted that model into finding people that we want to be a part of our community. So as we went through the process, we looked at, what does someone who makes a level income between, $80,000 and $100,000, what does their disposable income look like? What's their revenue generated for the community? What type of tax base do they have? Because we're looking at, they create the needs for services. They need to get their haircut, their oil changed, all of those items in our community. So while we don't have the first one moved here yet, the cost benefit analysis actually is a very good return on investment from working to bring someone and hopefully their family to be a part of our community, not only in time and talent, but also treasure. We work to grow our tax base. If we don't grow our tax base in order to fund ongoing expenses and inflationary costs, we have to do one of two things: raise taxes, which doesn't do anybody good, or cut services, which nobody wants. So we're looking to grow our tax base. This is a part of that, and bringing more people to live in Greensburg, Indiana, or Decatur County is an important piece of that. So yeah, the cost benefit analysis has been ran and seems to be trending in the right direction. And I think that's why you're seeing so many other communities across the country honestly take this up after Greensburg, Indiana has, in a way that is sort of rocket sledding forward in a way that works.
And Evan, I suppose there's just a few stipulations, fine print here to highlight when we look at you got to be eligible to work in the U.S., got to be at least 18, got to relocate, at least in the Greensburg one we're discussing here, next 6 to 12 months. When you look at maybe the fears of maybe people constantly nomadic, as we've all learned to be in the pandemic, maybe hopping from each town to town on your platform. I suppose someone, if they really wanted to, could play that game. But I mean, what I guess have you seen in terms of that, and who's actually turning to you? Is it all digital nomads?
It's not so much nomads, but folks that are trying to find their place. $5,000 and $10,000. No one's making a bunch of profit off that. Really, the goal of the cash is to de-risk a move, to make it easier to cover the actual cost of the move. But for all of these communities, I think retention is an important consideration. How are they helping these folks plant some roots in the community so that they don't want to leave? And I think, that part of the reason we love Greensburg's offer is it does a great job of sort of starting to think creatively about how to get those folks plugged in, introducing folks to locals, getting them invited to local events. We expect the people that are selected to stay long-term.
What kind of deviant am I to be already trying to figure out a way to game the system that you guys have put together here? I need to get out of New York, clearly. That's what I need to do. I might need to make my own move here. But appreciate you guys coming on here to chat with me. Mayor Joshua Marsh, Greensburg, Indiana, alongside Evan Hafer, MakeMyMove's co-founder. Thanks again for the time, guys. Welcome back to Yahoo Finance Live. In the real estate report, we are focusing in on the action playing out at Zillow as shares absolutely get shellacked, and I'm not overusing that term today. Shares off more than 20% as Zillow announced it plans to take write-downs of as much as $569 million and is slashing its workforce by 25%. After failures at its iBuying program, the company said it's going to be winding down that segment of the business that had been trying to buy and flip houses, and it had not been going the way the company intended. And for more on all that playing out, I want to bring on Barbara Corcoran. Of course, you know her as the Corcoran Group founder and host of Shark Tank on ABC. And Barbara, good to be chatting with you again. I mean, a lot of people have been pointing out it's difficult to fathom you could have something like this not working out in one of the hottest real estate markets in a while. But I guess there are some problems there at Zillow. What do you make of maybe the idea of that many losses stacking up?
Well, CEO Richard Burton is a phenomenal businessman. He's a disruptor. He disrupted the travel space with Expedia. He disrupted totally the real estate space with Zillow and the other brands that he owns. It's really a conglomerate. So no one really thought they could stumble, but what he did, and I'm sure he gave it a lot of thought, and I'm sure he was well advised by a lot of committees, but what he did was he went into a space that has nothing to do with finding homes for people. It's buying homes for flipping. And none of the stars align. I remember at the time thinking, what the heck is he doing that for? It makes no sense at all. And I got it because it was very appealing and tempting at the time to know that you controlled the whole house hunting market and you had access to all these sellers the moment they wanted to sell. So who wouldn't be tempted to say, hey, let's cash in, guys, and let's buy these houses? I think most of us would have reached the same conclusion. However, the part that was overlooked was the market is volatile. And that he said, I think in some press release, he was surprised the market was volatile. Well, that's real estate. It's always up, down, in between. It never stays the same. And what also happened is he never predicted how difficult it is to renovate a home, close it, and put it back for sale. And that's the juggernaut in this whole thing that he couldn't get past. And that really has been the problem that he has. Great concept. But for anybody who's renovated a kitchen, you know how hard it is to get a contractor. And in these days, finding help is impossible. So he really bit off a lot more than I'm sure he ever envisioned that he would have to chew. Yeah.
Well, Barbara, we have a big Fed decision in just over an hour here. And I'm bringing it up because interest rate, they matter to your business, the cost of capital. And we're expecting an announcement of the taper. I'm not going to get into the weeds there, but eventually we're going to see higher rates here in the U.S., we think. How does that affect the deal pipeline that you deal with on a day-to-day basis?
I'm really not worried about interest rates. Of course, they're exorbitantly low, and people assume it's American right now, like they breathe and they get low interest rates, right? But I don't think the Fed has made any announcements to do anything abruptly. I think they're going to increase the rates little by little over the next few years, or so they say. I don't know why I would mistrust that, but the market can certainly absorb it. Will it take down the market or make it pause? No, it will make house owning expensive. But what the buyers have proven over the last year, at least year and a half, is they're willing to pay more and pay more. And so the interest will be added to it. But as long as it's not a jerk up in interest prices, the consumer is more than happy to absorb that right now. That's how strong the market is. I don't think it will have a big effect.
Yeah, Barbara,
in fact, if I might add one thing, immediately the effect will be, it will help the market because people will think the good old days are over. People will really jump and overpay for the next house.
Well, it could be a bit of a boost here, maybe to unwind some of the problems at Zillow too, because I want to get back to that. Because some people are saying that this could be a buying opportunity, and we've seen some buyers. I think Kathy Wood swooping in here to buy on this dip as we see shares off more than 20%. And it sounds like you're kind of confident still in the platform itself. Sounds like this was just a bit of a misstep in terms of rolling this out and really leaning into Zillow offers a bit more than the company should have. So, I mean, would you be still confident in what Zillow can do here in terms of turning this around and getting out of it?
You're reading my mind. I was thinking about that this morning, thinking, hey, is this a great time to bet a jump, something that's discounted? I think it's close to 30% since 6 months ago. What an opportunity when someone controls the market. I mean, who could argue against that? But it depends on the cost of carrying those houses, which they plan to sell to institutional investors. It really depends upon how deep that inventory really is, how much cash is being drained. And I don't think we have those numbers yet. So it's a question of, is this the problem over now? They're not going to do it anymore. But what about the old problem, and what's it going to cost the business to really unwind that? So I'm not sure they're out of the woods yet. I'd be too hesitant myself. I'm sorry if I look like a scaredy cat, but I am.
That's fine. You got to protect your money. But just sticking with kind of the theme of disruption within the real estate industry, what other deals are you looking at, or what other concepts that kind of caught your eye recently that we might not have seen before?
I don't see anything in the real estate space. The last big disruptor was Rich Burton, because he had the foresight to see that buyers wanted more control of how they shop for real estate. He saw the same challenge in the travel space, and he capitalized on it. I haven't seen anyone in the space. I mean, I guess you could count Open Door, who buys twice as many houses as Zillow, and I'm sure that had a lot to do with fueling those guys over there. Whoa, look what they're doing. Let's jump in there. I could almost be at that boardroom picturing that thing going down, right? But Open Door buys houses, flips houses, and so far they've been in it twice as long as Zillow, 7 years, I think, close to 7 years. But even their confidence in iBuying is going to ripple through to them a little bit too, I think. So you could say Open Door is a disruptor, buying homes everywhere and flipping them, but you can't forget about the market. This is not a good flipping market. This is a seller's market where every home is dear. And how do you really make money on that spread? It's tough, not to even count for how do you get the workers to do the renovation. I don't know what's going on with Open Door, but it'll be interesting to see how this really plays out.
Yeah, it's tough to find a lot of workers out there in a lot of different sectors. But I'm reminded of the last time we had you on, Barbara, and thinking back to kind of some of those calls. That's why I wanted to ask you about Zillow, is because you've been pretty spot on a few things. I remember asking you about Nikola and Trevor Milton and some of the issues there. Of course, you love Elon Musk and what he's doing at Tesla. We are going to be seeing Rivian come public, the Amazon-backed electric car maker there at a valuation above $60 billion if all goes well. But they're going to be taking on Tesla, and they're one of your favorites in what they're doing in the EV space. I'm just curious to get your take maybe on how you're seeing the battle shape up there as we have Rivian coming out at a valuation that's going to be more than Honda and Ford potentially as they go up against Tesla.
Yeah, hey, that's a great start, isn't it? They come out of the gate, everybody's believing in them. That's the easy part of selling. The hard part of selling is keep the sale going. And what you need to keep the sale going is a phenomenal leader. Okay, Tesla, what's great about him is he's a phenomenal leader. Everybody gets inspired by him. He's almost become a business god. That's hard to compete with. It's not only the magic of salesmanship, but it's the guts that go along with it that the guy has produced. So who knows about the other? I would be the last person to guess so early, but it will be a battle. Do you think that guy's going to move over so fast for a competitor? No way. I'm still getting in my car and driving away. Yep, I am.
Well, Barbara Corcoran there weighing in on everything here for us. We threw a lot at you. Appreciate you coming back on to chat and give us your insights. The Corcoran Group founder and host of Shark Tank on ABC, Barbara Corcoran. Thanks again.
Rocket Companies posted quarterly sales and profits that topped estimates yesterday as a still hot housing market helped fuel results for the largest mortgage lender in the U.S. Jay Farner, Vice Chairman and CEO of Rocket Companies, joins us now. Jay, thank you so much for being here this morning. And taking a look at Rocket Mortgage specifically, that part of the company has seen some major growth in closed loan origination volume. Saw that was up nearly 120% compared to the same quarter in 2019. What are you seeing that's really been driving this kind of growth?
Yeah, this growth is all about our platform, Emily, and the work that we've been doing the last few years to really be able to scale. And so in 2020, we demonstrated we could do that. In 2021, we're calling for another record year. We're pacing to do about $30 billion more in 21 in terms of closed loan volume than we did in 2020. And we're also talking about making sure that in 2022, we actually cross over 10% market share. So the scale, the client experience, the brand, and of course our team members, all those things together have allowed for exceptional growth these last few years.
Jay, why is there disconnect? I look at these results, another quarter of very large numbers in many areas, but the stock hasn't reacted accordingly. What's the market missing here?
Yeah, we are an interesting player in the market. When you think about the Rocket platform, of course, we're the largest mortgage lender here in the country. We're setting purchase records. Q3 was the largest purchase mortgage volume that we'd ever done. We've got Rocket Auto, which is now pacing to be one of the top 10 used car platforms in the country. We've got Rocket Homes, which is on pace to be in the top 20 of all real estate brokerages in the country. But there's really no one else like us in the industry. And so I think we're starting to teach the world the difference between our platform and a traditional mortgage lender. And we're going to have to work through that process. But on the positive side, it creates a great buying opportunity for our stock. And as we've talked about, for us, buying stock back at these levels is something that we've been doing and will continue to consider because we think it offers a great value. So I've been here 26 years. We're investing in the long run. We'll keep doing that. And my firm belief is that over time, the stock will demonstrate the real value of the platform.
Yeah, Jay, you have $5.1 billion in cash. You talked a lot about this, your cash allocation on the call last night. So sounds like you're about to get more aggressive and buy your stock.
Yeah, I love the value of the stock at the price that it's currently at. I also am watching the market closely because as you think about where we've been the last 24 months, especially with fintechs, I think the opportunity to look for acquisitions that could fit in nicely to our platform will present itself as we go into 2022. So it's great to be sitting on that level of capital. As you know, we're a very capital light business. We don't require that capital. And so we can use it to buy shares back. We can use it to make key acquisitions. We can use it to do another dividend like we did in the spring of this year. A lot of opportunity here for us to add value to our platform.
Jay, we're looking at a higher interest rate environment heading into next year and beyond. How are the different portions of your company going to be impacted by that kind of higher rate environment?
Yeah, our mission over the last decade has been able to diversify how we acquire our mortgage production. And so we started as a direct consumer business. We built one of the largest and most recognizable brands, first with Quicken Loans and now Rocket. But during that period of time, we've also been growing our ability to reach mortgage brokers, real estate agents, financial planners, insurance agents. We recently launched our Salesforce partnership so we can be plugged into banks and credit unions across the country. So even if the mortgage market shrinks, let's say it goes to $3 trillion in 2022, our ability to flex and grow into that market and grow market share, we're incredibly well positioned to do that. And so I think of us as a different type of company than other traditional mortgage lenders. And so rates will go up, rates will go down, but as long as we stay on our path to grow these distribution channels and then engage our client base, we've got 2.5 million people making mortgage payments to us right now. We've got equity that it's gone from 19 trillion to 24 trillion. So there's a great opportunity for people to pull cash out. We can grow regardless of whether interest rates go up or down.
Jay, obviously you're tied to all trends in the housing market, and today is Jobs Day in America. Are you seeing any relief in the labor shortage amongst home builders? I mean, this has really held back that space, and I would argue it's held back your industry too.
I think we're all facing this. If you're out looking to hire someone today, the challenges have been probably the most difficult we've seen in many, many years now. That's why there's less than two and a half months worth of housing inventory out there. And we expect that demand will stay strong into 2022. And so it's good to see that we're getting people back into the labor markets. But I think we've got another 6 months to a year of some challenges where we focus is culture. If we can ensure that we've got a great culture for our 26,000 team members, they really see the vision of what we're building, they feel the passion of what we're doing, that we know we can attract great talent and keep the talent we have. And so we're just doubling down on that aspect of it. And it's worked. We've been able to grow. In fact, we've hired somewhere north of 5,000 people in the last 2 years based on that. And so I think that's the best place for us to put our energy as we go through this kind of labor challenge.
You also made a good point on the call last night, Jay, that homeowners are sitting on a great deal of home equity. How do you see that impacting the economy next year?
Yeah, so whether the 30-year fixed interest rate is at 2.875 or 3% or 3.5%, this is still incredibly low interest rates, and it offers a great opportunity for consumers across America. And so as we watch our non-rate sensitive mortgage production, purchase, term adjustment, a lot of folks are going from a 30-year to a 20-year or a 15-year or cash out. A majority of our loan production falls into this non-rate sensitive bucket. We think that will accelerate in 2022 as people recognize the equity that's been built up in their home. And so leveraging those distribution channels I spoke about earlier, leveraging our brand and our marketing so we can make people aware of this great opportunity, that's where our marketing team is focused. And again, that's going to help us get to north of 10% market share as we go into next year.
And Rocket Companies has a new partnership now with Salesforce to provide mortgage as a service. I'm wondering, what has the customer demand been like for these types of services, and what are you hoping to build out through this partnership?
Yeah, when you talk to banks, credit unions, in a great market like 2020, you'll see more people get involved in mortgage. But for the most part, it's a challenging industry for people to have it make sense. We've been able to be incredibly profitable and drive great client experience. So we thought about our technology, the investments we've made. We also have been partnered with Salesforce for quite some time, and we started recognizing the great benefit to having that client 360 view that Salesforce provides. And so thinking about other banks and credit unions that are using the Salesforce Financial Services Cloud and thinking about how we could plug Rocket Mortgage technology into that cloud, not only can they leverage the Salesforce tech, but they can leverage our tech, our experience. And so there are 10,000 banks and credit unions out there. Thousands already use the Salesforce Financial Services Cloud. And if we take the Salesforce and the Rocket company's Salesforce, and together we go out and explain the great benefits of plugging in, we think we can have access, like I said, to nearly 10,000 banks and credit unions. They can provide their client this great mortgage experience leveraging our technology. It should be a win-win, and it gives us access to nearly $1 trillion of mortgage volume that was done through those channels last year. So really exciting for us, really exciting for Salesforce, and most importantly, exciting for the clients at these banks and credit unions.
We'll leave it there. Jay Farner, Vice Chairman and CEO of Rocket Companies, thank you so much.
Shares of Vista Outdoors are hovering around a 52-week high as the outdoor products maker sees strong sales of ammo and golf equipment. The company is also getting good marks by the street for the recent acquisitions of a golf tech business and another that sells wood pellets. Chris Metz is Vista Outdoor CEO and joins us now. Chris, good to see you here. We'll talk about the quarter, but I want to talk about the repositioning of your company here. You've been making some recent acquisitions. Why are you making some of these purchases, especially in the golf space?
Well, first of all, as it relates to acquisitions, so we've grown about $1 billion in sales over the past 2 years, and it's really broadly spread both organically and inorganically through acquisitions. We've closed on 6 acquisitions in the past 14 months, and we're sitting at about a 1-time leverage right now. So we've got a great balance sheet generating over $300 million in free cash flow. So we see it as a great opportunity to leg into some of these high growth acquisitions. So take golf, for example. The fastest growing segment of golf right now is collecting data and using that data to improve your golf game. So Foresight is the leader, has the majority share of the top PGA golfers, and we're able to take that technology, continue to grow with the high end of the market, but also bring it into a more affordable price point for consumers with Bushnell Golf. Another fast growing segment is outdoor cooking. And we've got one of the leading brands in Camp Chef, and we bought a fiber pellet. Well, it's not fiber pellet, it's called Fiber Energy, but the wood products are formed into pellets, which then fuel these outdoor pellet grills. And just a super fast growing market, something that we're really excited about for our Camp Chef business. So 2 high growth industries that complement our overall sports businesses.
Is there another category that you're eyeing that you're not in and would like to get in?
Well, I'll tell you, so we just got into electric bikes too with the leading off-road bike company called Quiet Cat. So we see that as another kind of hyper growth category, if you will. And we're evaluating all of our platforms and where we play today. And those are first and foremost the categories that we want to continue to grow in. And then we're also looking at near adjacencies. So you look at the categories that we participate in today, and those that are closest to it really play off the strengths and the competencies within Vista Outdoor. And one of the things we did when I joined is we created these centers of excellence. And so we've created centers of excellence where we can bring in world-class expertise in things like digital commerce and things like supply chain and procurement, where any of our individual 40 brands wouldn't otherwise be able to do themselves. So the latest one we've done about 1.5 years ago, we added a M&A capability, and we've really built that muscle up. So we've got a strong pipeline of potential acquisition targets that we're looking at to continue the growth that we're seeing today.
Chris, this is Emily. You mentioned on your earnings call that production was hampered by raw material shortages and logistic challenges. I'm wondering, where are you seeing the most pressure, and how long do you expect these pressures to last?
So Emily, it's a good question. And honestly, we're seeing pressure across the board. So we're seeing everything from raw materials and the key inputs to our products, whether it be precious metals, whether it be chips that go in our Bluetooth enabled pellet grills or our laser rangefinders for our golf technology. We're really seeing it across the board. And then where we source product and partner with some of our contract manufacturers, all the logistics challenges that you read about, whether it be containers, shipping shortages, rail shortages, port shortages, and all of this is because of the demand that we're seeing in the industry. And how long does this go? At least for the next couple of quarters before it gets to a more normalized environment is what we're seeing.
Have you had to raise prices, Chris?
Well, we have. And so the inflation that exists today is it's real. I mean, we've got input pressures, whether it be labor costs or what have you, that we have to offset. Now, fortunately, we've got some of the most powerful brands in the industry. In fact, we've got 10 brands that in of themselves are over $100 million in sales. So it gives us a bit of pricing power, if you will, but we're very, very careful that we don't want to drive prices to the point that affects demand. So we have taken prices where we've seen input costs increase.
Record quarter for you, and another strong quarter, I should say, in ammo. Are people hoarding ammo, and why would they be doing that?
You know, we don't believe so. We believe that the consumption is off the charts. And what's happened here is boy, the amount of users that have come into the industry over the past a couple of years is up 30%. And so that is evidenced by the diversity of users. We're seeing young people come in. We're seeing gender diversity. We're seeing more people of color, really creating a more inclusive type of industry. We're seeing hunting licenses grow to the highest level since 1958. And people are rediscovering or discovering for the first time the joys of being out in the field and harvesting your own game for field to table, or out participating in clay shooting and other sporting activities that really consume a broad variety of ammunition.